welcome back to ClearPath Retirement Radio. I'm Stuart Smith, and I'm here again with Mitch Davies, and I'm going to introduce one of my favorite segments of the show that Mitch does. It's called Mitch's Market Minute, and he's going to talk about the market for a few minutes, so take it away, Mitch.
Excited, Stuart. Excited, as always. We're going to break down the market minute into the same three components we're going to try to keep up. One, where we're at today. Two, where we're at for the year. And then three, what's the main theme we're seeing? What's trending? What's the hot topic? What sectors are we looking at? Last week, we talked a lot about energy. So to start off where we're at, last week we saw the S&P jump over 7,000 for the first time, which is exciting. And we're back just under 7,000 there on the S&P. NASDAQ sitting right above 25,000. So when you look at year to date, where we're at from January 1st, it's been flat to slightly up. And the trend we've seen, Stuart, is that the red days and the days feel really heavy right now. The red days feel big. And we've kind of just been passing the same percentage or two back and forth all year. And this is, again, a theme we're continuing from last year where the changes feel so heavy. But then if you look at it over a 12-month frame, we really haven't moved much. But the red days feel so dramatic because what we were talking about earlier, where these headlines, these stations are designed to bring fear in, to bring clicks in, to bring up emotions. And so we see these red days feel really hectic. And a lot of that has to do with these headlines, these geopolitical things. But overall, we're pretty much where we started the year, maybe slightly up. The Russell 2000, kind of the small caps, are leading the way right now. And this was talked about a ton in Q4, Q3 last year, was kind of this shift from what we've seen the hyperscalers, the big tech kind of dominate. And everyone was talking about it's time to rotate into small caps. This is a conversation we were having with clients at the firm actually earlier in the year, was that small caps are starting to take over. We really tried to allocate some into that because these valuations on these huge companies were just massive, right? The Apples, the NVIDIAs, the Teslas, the valuations are so high, so we're trying to find where the value is next. What we're thinking for the year here is the economy is holding up. Despite the whatever headlines you're seeing, jobs are solid. We had the jobs report get delayed, but unemployment still came out okay. Inflation looks fine. Consumer spending is still high, and we're actually reaching a sneaky high consumer spending point coming up here in the next month or two. Not as high as the Christmas kind of holidays, but we're going to see a high consumer spending area, and we've had a lot of big company earnings reports, and they've been good. They've been good. And one thing I want to talk about is we've seen a lot of these huge companies like Microsoft. A couple weeks ago, they reported earnings, they beat earnings and dropped 10%, and it caused the whole market to really come down. And this is a trend we've seen a lot of, where these major companies are trading at relatively low price to earnings ratio. All that means is that the price you can buy how much money they're earning is low compared to what it usually is. Usually you have to pay a huge premium to own the Amazons, to own the NVIDIAs, to own the Microsofts of the world. But right now they're trading within that 20 to 30 PE range is what we call it. And that's actually what the S&P average is. And over the last 4 or 5 years, in order to own those huge companies, you had to pay 100 times price to earnings ratio, which you generally want to avoid. The typical value investor won't go that high. They focus on where's the value. And what we're seeing now, which is so interesting, is these big companies are actually down a ton the last 6 months, and they're turning into value stocks, which is really an interesting shift we haven't seen in a few years. The other main thing I want to talk about, what everyone's been talking about recently, is gold and silver. We saw gold break through 5,000. We saw silver run up to 120 an ounce, right? And this is, I actually, at the firm, we do a weekly market update for all our clients, and I wrote about this. Silver, in its entire existence as being listed as a commodity on the market, it had never seen the kind of gains ever that it did in the 3 months to end last year. It had a higher spike in 3 months than it ever had since 1890 when it got listed on the market. While we still feel great about silver this year, we said to a couple clients who've been holding it for 15, 20 years, hey, if you're in retirement, if you're in your 70s and you've been holding silver for this a long time, it might not be a bad move to offload some of that and realize some of this profit, because for the 15 years prior to that, it really didn't do anything, right? Silver kind of traded in between the 20 to 40 an ounce range for almost 15 years. So we've seen a crazy growth in metals. We've seen some of these mega cap tech companies actually turn into value plays. So those are the two things we're watching right now. Overall, we're feeling really good about the market. And we'll look forward to coming back to the Market Minute next week and breaking down where we're at and continuing the conversation.